All right, welcome to day 3 to Back to School with Simply Pips. Today we'll be going straight into AQZ itself proper. And the very first thing I want us to note is that AQZ has a Telegram group of its own. I'll be showing us that Telegram group at the end of the webinar today. And I advise you join and interact. Of course, you could drop AQZ-related chats on Simply Pips. We're basically one and the same. I'm recording right now a box. All right, so when we started this discussion, we made mention of 2 horizontal blue lines, or sometimes we even box them out. We box our candlesticks. So a very good friend decided to put up this fib. This is actually a Fibonacci. This is actually the Fibonacci you know, right? The normal Fibonacci you know, but with some improvements or alterations on some of the data. And now this Fibonacci, of course, there's a book, there's a PDF that explains the figures you find in the Fibonacci, that is the settings. I won't spend time explaining that in this webinar. But this box, we use it to box out our AQZ qualifying candles. And then we decide to take trades off them. We call this an AQZ block. We call this an AQZ block. The lower part here is the tip of the block. So that we have 2 tips. One tip here and the other here. And this lighter part is called the PE. Full meaning is preferred entry. We call it the preferred entry. Basic reason is simply because it gives us a smaller stop loss, and therefore we can have bigger wins, right? That's our preferred entry. When we are selling, everything here becomes our sell zone. Everything there becomes our sell zone up to the preferred entry. If price closes above the preferred entry for a sell bias, we say that the sell has been invalidated. We say the sell has been invalidated. So we'll change our mind from the sell and wait if we must sell for price to come back and close beneath. Or in fact, we could even change our mind and anticipate a buy. If we are in a buy scenario, then everything here becomes our buy zone. And a close below the preferred entry gives us an invalidation of our buy. Right? So let's come back to the chart and see how we apply that. So let's go back to, was it GN we're using? Yeah, GN. GBP and ZD. And I love using Oanda because they basically do not show gaps. So let's say at this peak here, the highest candlestick pattern we can find is a bullish engulfing. You can see that. There's a bullish engulfing. Then price came back and closed below the bullish engulfing. And that gave us a violated bullish engulfing. That gave us a violated bullish engulfing. Remember, a violated bullish engulfing is a bearish signal. So what we would do, like we've been doing from day one, our focus is the candle to the left. So we'll flip from week to week, the candle to the left. If you use TradingView, like I'll suggest you do, when you want to draw your fibs, let me take out this line for now. When you want to draw your fib, I'll suggest you have this magnet. Look at this icon that looks like a horseshoe. Have it on so that it snaps straight up to the tip and to the bottom effortlessly. If you have made up your mind that you want to go in for a sell, when price closed above the PE, we say that our sell dated. We say our sell bias has been invalidated. Then when price came back and closed below, we say our sell bias is revalidated. So we're anticipating sells. If you remember the rule we had for ourselves for bearish engulfing, we said we could sell straight up from this point. Let me use a different color. We said we could sell straight up from here, or we could wait for price to come back to this point and sell. And price actually sold off from that point. But the problem is I didn't sell for too long. Then it pushed back up and closed above our preferred entry. Once price closed above our preferred entry, we say that our buy bias has been invalidated. But when price came back and closed below the preferred entry, our bias has been invalidated. I want to mute out everybody again, like I used to. All right, let's continue. So when price came back and closed below, we would now resume our sells, right? Now we can resume our sell. Inside this revalidation, we could still apply our rules. And what are the rules? This is a bearish engulfing. So will it be wrong if I do this? It won't be wrong if I do this inside, and I'm having another AQZ qualifying candle, a bearish engulfing inside the previous one. And now I have my entries, and price continues to drop. Right? We can see that. Now let's move on. So we have two AQZ blocks. We have another bearish engulfing. Again, I can have my AQZ block on that one. Price never really came back for me to sell. No problem. Price dropped lower. And then price gave us another AQZ qualifying candle. I could as well do this. And I'm looking for sales alone. Price closed below. Price came to my preferred entry, and then I drop. So I can do this over and over. Remember what we said, over and over the qualifying candles. So if you use the example I used at the beginning for 5 minutes or 15 minutes, you could do exactly the same thing, right? So that is the AQZ block. But the AQZ has a full fib settings, and it looks something like this. Sorry, it looks something like this, AQZ fibs. This is the full fib settings for AQZ. Again, we have our AQZ block. This area here is called our stop hunt zone. Then if this This is our PE. This is our A1, A2, and like that, A3. So we're basically saying these are TP1, TP2, TP3, and like that, if we enter the trade from the preferred entry. However, if you enter the trade from the tip here, let's use a different color. If you enter the trade from here, then this will be this black line in between will be your TP1, and the black line here will be your TP2, and so on and so forth, right? So we're actually using measured move. The distance from this point, from this PE to this that looks like a PE, is equidistant to this other one. It's basically the same distance. And the distance from this level to this is equal to the distance from this point to this. So you can easily measure out your take profits. Now, the whole thing put together, the whole FIP setting put together is called our AQZ roadmap. So we have our roadmap, we have our entry, we know when to get out of our trades, we know when we anticipate that a stop hunt will be made, and we know how to take the trade. So that's the basic AQZ FIPS. The settings are in the AQZ discussion group, Telegram group. I'll flash that at the end of this webinar so you know where to find them. Remember, we are looking at those candlestick patterns. We are not relying on the AQZ FIPS to know what to trade. We are looking at the candlestick patterns, and we are putting the FIPS on the candlestick patterns, right? So now let's move on. So I mentioned earlier that you could use this for a ranging market, and you could use it for a trending market. So let's focus on a ranging market, something like this, right? In no particular order. When we find a ranging market, we look for the ones at the peak. We look for this guy at the peak, the highest point, and this guy at the lowest point. Those are the areas we'll put our AQZ FIB and then anticipate trade ideas from them. You always want to trade from the peak, right? You might be able to take some trades in between when you get skillful using the AQZ. But for now, let's focus on trading from the peaks. I'm going to try and find a price action that has been ranging for a while. And then we'll see if we could get a trade off of that. I think I saw one just now. Squeeze it in a little. And then we take trade off of, we find how to analyze that. Quickly check another pair. Currencies, EJ. Hasn't been ranging per se. Okay, we'll stay put with this. All right, good example. Okay, so you notice what price has been doing. Price went down, bounced off, pushed up, and came back down. Somebody asked yesterday, how would you know? Of course, you wouldn't have known it was a ranging market. First you had a push down, push up, it came back to that same level, 2 touches, now you know you are in a ranging market, at least for the lower part, or you have a support, as the case may be, right? So how do we treat this? What is the AQZ qualifying candle? We can find at the bottom here, we have something that looks like a bullish engulfing. So we'll FIB for a buy. Again, I forgot to mention, if you are FIBing for a buy, you FIB the candle to the left from the bottom to the top. And if you are FIBing for a sell, you FIB from the top to the bottom. So When I was fibbing this candle, you notice that I fibbed from the bottom to the top. From the bottom to the top. All right, somebody mentioned EN. We'll look at that. Okay, no, I guess maybe when I was asking which pair were we trading before. Or are you saying EN was consolidating? Right, so let's say that is what we have. And we are not sure if the top part is consolidating yet, but we don't want to bug ourselves with that. We'll assume it's consolidating for now. So we'll just move on with this webinar. So the topmost part we can see, again, we have an AQZ qualifying candle that looks like a bearish engulfing. We'll fib the candle to the left, which will be the bullish candle. Remember, we explained the theory from the very beginning. Right, so here we are. Let's say we already know that price is ranging, meaning that we have that inclination that price is ranging before now, just for the purpose of this illustration. We have the lowest point, we have the highest point. Notice how price got back to the highest point and then sold off. Notice how price came back to our buy zone and then bought off. Notice how price came back to our sell zone and then sold off, and then sold off, and then bought, and then sold. Right? You can see that. So when you are in a range, you want to look at the topmost part of your chart and the lowest part. You could trade in between as you get more skillful, right? But again, why would you want to risk yourself to the ridicule of the market? So let's quickly go to violation and invalidations and revalidation, the next thing we'll be discussing. So when we have the AQZ fib, we said if price closes above in a sell bias, we say that that is an invalidation. And then we'll begin to anticipate that if price closes bullish, we will now be anticipating for buys. But if price comes back and closes beneath, this is a revalidation. We will now resume our sell. So let's see how we play that with what we have here. So let's say initially we had this drawn out. Price went and closed above. Once price closes above, we will be anticipating that there's a tendency that price wants to continue to go up. So our bias, our sell bias has been invalidated, and we are now anticipating buys. But price came back and closed beneath. Now we are anticipating sells. Price pushed, didn't close, closed above, we are anticipating buys. It came in, bought, and came back and closed beneath, and now we are anticipating sells. And then you can see the drop-off from there. Price came the PE and sold off from there, right? Basically sold off from there. That's how we use the AQZ block with the preferred entry. I will state here clearly, if you trade the AQZ, you will have losing trades, but you have more winners. You have more winners, and your confidence will be high. Why? You know you're going to catch the market eventually. You know you're going to catch the market eventually. So let's move on to the next part. Now, the challenge for most people is opening the chart the very, very first time and knowing what to do exactly, even though we tried breaking it down to its various rudiments from day one. Again, if you watch the video a couple of times, you would be able to just look at the chart and perhaps find a direction for yourself if you are not too too impatient. But most people open the chart and the first thing that hits them is confusion. You're not too sure of what you want to do with the chart. So in the AQZ, we have what we call the prophetic candle. The prophetic candle basically helps us spot out some AQZ qualifying candles and then helps us to start taking decision from that point, right? So I'm going to call up the H4. We have the D1 prophetic candle. We have the H4 prophetic candle. In fact, we have the H1 prophetic candle. I'll be spending more time on the H4 prophetic candle for today. So when I tap out the H4 prophetic candle, you'll find something on my chart. You'll be finding some red arrows pointing downwards, telling us that we should anticipate sales, and we'll be fibbing, in this case, the bullish candle that the arrow is over. Sometimes we'll have signs of bullishness like this, right? Again, you want to be careful with this one because this is not an AQZ qualifying candle. This is more or less like the AQZ qualifying candle. So in this case, I would rather fib this than fib this, right? We're talking about AQZ qualifying candles. We discussed a pin bar quite right, but for the AQZ qualifying candles, we're looking at this. So that's how you treat the H4 PC. So we'll do some quick tests on the H4 PC so you see how we use it. So let's say we came up to our chart this week. Let's look at our chart this week. This is 26th of April. The first candlestick pattern we would have seen is a bullish AQZ pattern. Again, this is a bullish engulfing candle. So we would fib from this point to this point. This arrow would have appeared after price closed, after this, will I call it a hammer now, formed. Our bias will automatically become a buy, and we can buy anywhere within this zone. Notice how price pushed up, right? If I put on take profits, AQZ without stop hunts, you find our take profit 1, take profit 2, take profit 3 off of this bullish AQZ pattern. If you've been following what we've been saying before, when you find this bullish AQZ pattern, you should be happy. Why? Because it's coming off the heel of a bullish engulfing candlestick pattern, which again is a bullish sign on its own. So this is just telling you that we are going even more bullish, right? Let's go to the bearish one. So here we have a bearish AQZ. We would have fibbed from the top to the bottom, anticipating sells when price returns to that AQZ. So watch, price returned to the AQZ and sold. As small as that move is, it took us to TP2, or rather TP1.5, right? I'd like to call it TP1.5 because I mentioned that if you got in from here, then this should be your TP1. This TP1.5. If you got it from the preferred entry, then the A1, A2 becomes your TP of measured move. Notice how you would have caught that trade. If you know how to trade price action itself, you'd have caught that trade straight down and take your profit and leave. Price came back into that zone, pushed back into our preferred entry, and as it pushed into the preferred entry, it gave us a bullish H4. So basically, forget about the sell, and then we have the bullish one we saw earlier, right? But for the sake of this discussion, let's assume we never really saw the buy and we're just based on the sell. Price closed above our PE. This is an invalidation of our sell. We will now resume buys from there, and that is the buy we saw. So if you didn't get in from a buy based off of this bullish H4 prophetic candle, then you would have gotten in for a buy as a result of the violation, or rather the invalidation of the H4PC. Let's see other examples. Somebody mentioned GN, so let's call up GN and play around with GN on that too. So here we have GN, H4PC alone. So on GN, this is our H4PC. We would have fibbed this point to this. This is the breakout. This is the retest. It almost hit TP1, never did if you enter from that point, and then drop. Now we have an invalidation, and then price is selling off from there. We'll go to the next one. We had another bullish sign here. But remember, I gave a rule when we're looking at ranging markets that when you have two buys, you should concentrate more on the lower one and not the upper one. But let's assume you didn't hear that rule before. How would you have played this? You would have fibbed from this level to that level for a buy. So price close beneath, you'll be looking for sells. Price close above, you'll be looking for buy. Price close beneath, you'll be looking for sells, and eventually you sold off. Right? So whichever way the market takes, you will be there. You would have one or two losses along the line, but you will eventually hit the home run and make it big time. Now, so watch this point. Price invalidation, sold, came back again into the invalidation area and sold again. Right? So that's the way we trade the H4PC. Now here's another example. So I have this one here. I would have fibbed from this point down. So watch this. Price came back toward the preferred entry, invalidated, came back to retest and pushed up, never really made it, came back down to revalidate. Then we have our retest of PE to TP1, retest again, and then it dropped, and it's still dropping up to now. We have another candlestick pattern. So let's say we take this out and we flip this again. Again, bearish engulfing, retest of sell area, TP1, TP2, TP3, TP4, and it keeps going. Right? So notice the number of times you would have had winning trades vis-a-vis the number of times you would have had losing trades. And when you have winning trades, the how deep price goes, or how high price goes in your favor vis-a-vis when you have losing trades. I'll pause here for a while to state that in the few years I've been having to deal with traders, the basic problem most traders have, in my own honest opinion, is looking for a strategy that wouldn't lose at all. In fact, if you have 4 to 5 back-to-back losses, they basically abandon that strategy and go in search for something that will give them a better return. I'll be sharing an Excel with us briefly, and after then, we'll wrap it up for tonight. When we come back, we'll be looking at momentum shift vis-a-vis the H4PC. We'll be looking at the momentum shift. And on Friday, we'll look at certain ways I use the H4PC when we look for liquidity sweeps before we engage. So we wait to be sure that liquidity has been swept and then we engage. We can do that on 15 minutes. So you can use your AQZ right down to the 15 minutes, right down to the 1 hour, even 5 minutes if you want to, so as to narrow down your stop loss properly and then take your trade. So I'll be showing us an Excel we usually discuss with our team. Just a moment. All right. So we'll call this the asymmetrical compounding risk-reward ratio. Typically, we use a 1:3, but having heard from some persons that 1:3 might be difficult for them to get, we've modified it to 1:2. And by 1:2, I mean that for every trade you take, let's say you risk 1%, then your reward will be 2%. So your risk to reward is 1:2. That's what we're saying. So we're going to run a 2-step rinse and repeat. That's what we're going to do. And what do I mean by 2-step rinse and repeat? If we have a first trade and is a winner at 1:2, it means we would have risked 1% and gotten a reward of 2. Upon the second iteration of the trade, rather than risk 1%, we'll add this 1 to this 2 and now risk 3%. And again, the risk-reward ratio is still going to be 1:2. Our target to make 6%, which is 2 times 3. If we do this, this is 2 winning trades. 2 winning trades. We will rinse and repeat. We'll go back and start from 1:2 again. So we rinse and repeat specifically on 2 occasions. Number 1, when we have 2 back-to-back wins, or when we just have a losing trade. When we have a losing trade, we go back to 1:2 again. Now watch this, so that we don't bug ourselves too much with precision. No matter how you refine your trade, if price is going to go up, it's going to go up, right? So here we have let's take what we have here. This is a serial number of 25 iterations. This is the risk per trade. So the first trade was, the risk on the first trade was 1%. The outcome is either 1 or 0. When if it's 1, it means it is a winning trade. If it's 0, it means it's a losing trade. So the outcome for this is a 1. The implication is that you want 2%. So the account will be up 2%. The account will be up 2%. Now you add this 2% to the 1 you would have used initially. The second trade, you'll be risking 3%. If you happen to have won this trade, the implication is that we would have won 6%. Now your account is in total of 8%. Then you go back and start again from 1. That's the rinse and repeat, right? So we have a randomizer here where we can basically change this thing in completely random. It will change it in no specific order. If you follow this thing from 1 to 25, using 1:2 alone, after 25 trades, your account would have grown by 33% if it follows this order. Now let's change this. Now we have 14 wins out of 25 trades, which is a 56% win rate. We had 21% growth on that account. Note that we had 3 back-to-back losses at some point in time, but the account still grew by 21% because with this this is 15%, 15, which is 60% win. Your account would have grown by 28%. Let's find another iteration. All right, very good. So watch this. This is a 44% win rate. 44% win rate. Lower than average. And this trade had, at one point in time, 2 back-to-back losses, followed by 3 back-to-back losses, then followed by 1, 2, 3, 4, 5 back-to-back losses. But the account was still up after 25 trades by 6%. By 6%. So this puts a nonsense, a tag of nonsense on the desire for traders to seek, a holy grail of a strategy. If you can have 5 back-to-back losses on the heels of 3 back-to-back losses and 2 back-to-back losses, and you basically lost 14 trades out of 25, and your account is still net positive by 6%, then what's the issue? So you could basically trade what we just said here, have your AQZ, pull it up, price broke beneath, price came back into sell area, gave you TP1, TP2, 1:2. You pick the next trade. If you know how to trade based on what we explained, that you could use this both in a trend and in a range, it broke down at the topmost part. What candlestick pattern can you find? Oh, I can find this candlestick pattern. Price broke beneath, price came back, most likely would have given you maybe TP1 or TP2, came back again and then dropped. Just watch that. Again, if I put my fibs without stop loss, so the first one gave us TP1, pushed back, gave us TP1, TP2, and the likes. Again, exactly what we're saying. So the force over, you are trying to refine it, you are trying to put so many things, is not necessary. You will lose no matter how you twist it. Just follow the simple rules that have been set aside to trade AQZ and ensure that for every trade you take, you are making more, you are taking more from the market than you are giving to the market when you lose. And that is all we need. So we'll come back tomorrow, we'll go down to 1 hour and see how we can trade the AQZ fib on 1 hour. Then we'll quickly go into MS, what we call the momentum shift, and proceed. I'll stop here for today.